Welcome, everyone. Happy 2019.
Okay, thank you so much, David, and thank you for the invitation. It is always an honor to be invited. Now, I look around this room and I see a lot of experienced and well-respected real estate people, investors, brokers, and people that have been in the market for a long time. But what it tells me is that we have been through a lot of cycles together. So what I'd like to do in this talk is talk about what's happened in the recent past, where we are right now in the cycle, and then some thoughts for 2019 and 2020. Specific topics will be covering some macro issues, including employment, interest rates, population growth, home ownership rates, income levels, and apartment construction. We'll also be talking about some of the fundamentals of the apartment industry, in particular rents, income, vacancies, and expenses. And we'll also be talking about apartment sales volume and what kind of year 2018 was in terms of volume and transactions. And we'll also be talking about apartment values and what's happening there. And then we'll conclude with some talks about the political climate and URMs, and then conclude the talk with some thoughts of where the market's going in 2019 and 2020. Now, when I look at the apartment market, I want to put it in perspective. So one of the things I do is look at what's happening with the economy. So needless to say, nationally, the employment figures have been very strong. What we're down to about 3.7% unemployment rate versus 4.4% a year ago, and we've had gradual declines in the unemployment rate. We're clearly at full employment. Now, you keep waiting for the shoe to drop, but the job figures were weak in November, but they were very strong in October, or in December. So we gained over 300,000 jobs. So certainly that was very good news, and it's one reason that people are thinking, gee, maybe we're going to have some more increases in interest rates. In looking at GDP, you can see that the last quarters, which are the second and third of 2018, were strong and better than any of the other quarters we've had in recent years. Now, keep in mind that this is in comparison with an average of about 2.5% GDP growth in the previous 6 or 8 years. As far as the Oregon economy, very favorable numbers. Now, I particularly like this chart because this shows the population growth, and the dark blue is in migration, and the light blue at the top shows the total, or shows the natural increase. You can see here the reason Oregon, and also the reason Portland is growing, and it's been so strong, is because of in-migration. Currently, we've had population growth about 1.5% in Oregon, and a little stronger in Portland. As far as Portland population growth, we've had figures of excess of 40,000 people, though last year was a little slower, somewhere around 37,000, and they expect somewhere around 27,000 new people the next year. Now, this has big implications for the apartment market. And one thing I like to do is kind of a seat of the pants analysis of population growth and what that means for apartment demand. So you work some quick figures on average household size, which is in Portland Metro is about 2.35, and you come demand for about 13,000 units. And then if you figure 40% of that will be multifamily, it tells me that there's demand for about 5,300 units. This is not terribly scientific, but I think it puts you in the ballpark. And another ratio might be so many apartments for every job. And one ratio is 1 apartment for every 6 jobs. So what it tells me is that demand is somewhere between maybe 4,500 and 6,000 apartment units. And so then when we see what the supply is, we can get a handle on kind of where that market is going. As far as, let's see. Okay, as far as, these are the figures for Portland Metro in comparison with the nation. And you can see that Portland Metro very much follows the nation and very strong employment figures. But keep in mind that in 2015, we added 35,000 jobs. In 2016, we added 30,000 jobs. In 2017, we added 28,000 jobs. And last year, we added 28. So even though these are good numbers and we're having good job growth, it's been pulling back a little bit from the peak. Not a lot of great big announcements, but I think one of the bigger ones this last year was concerning Amazon and their big facility out in Troutdale, adding about 1,500 jobs. Now, this chart I find fascinating. And a lot of times people will look at these new buildings and the first thing they say is, gee, how can people afford these units? Well, this chart I find particularly interesting because if you look back to 2008, 2009, 2010, the Portland had about median income about $2,000 to $3,000 per year over the national average, or the average for the large metro areas. But you can see now it's up to 10,000. So what it's telling me is that the in-migration has been people with much higher incomes. There's one, the next chart I think you'll find, I find fascinating. And basically on one axis on the left is the household income, the lower axis is educational attainment. And you can see that Portland has had a huge jump in terms of the percentage of people who have college degrees over the last, say, 6 or 8 years. And we're right up there with San Francisco. Well, San Francisco and San Jose are a little bit ahead of us in terms of income growth and educational growth, but we're ahead of towns like Denver and Austin and Seattle. So this, to me, these is a good reason why the economy's been so strong and why the apartment market has held its own despite record construction. Looking at mortgage rates, we started the year about 3.9% in January. We went up to almost 5%, and since then, with some of the turbulence going on in the economy and in the markets, it's pulled back to about 4.5%. So also in looking at mortgage rates for apartments, I don't follow that real closely, but I get a lot of flyers in the mail, and the stuff I've seen, basically it's a low of about 4.4 and a high of about 5.5, and the big difference is the term and the loan to value and the quality of the asset and maybe the credit and some other things. So, so even though interest rates are up about maybe 60 basis points over the last year, though are down from the peak. Treasuries started the year at 2.7. They went up to started the year at 2.5. They went up to 3.2, and now they're somewhere around 2.7. So interest rates have pulled back. Now, the reason I think this is so important is because many investors buy based on the spread between some index, and there are different indexes. You know, I don't think Treasuries is a good index, but maybe the bond index or whatever index you want, where you can figure out the right spread for whatever you're buying. And what's happened is, historically, the spread has been somewhere between 200 and 400 basis points. But now the spread is closer to about 165 basis points. So even though interest rates have moved up, the spread has tightened. And so this, needless to say, is critical for what I do, and that's kind of watching what's happening with apartment values. I think the increase in interest rates has had some impact on apartment values, and I'll be talking about that shortly. Okay, home ownership. Home ownership is another thing that I watch pretty closely, mainly because it can have such a big impact on the apartment market in terms of renters leaving apartments and going to buy houses. Now, this figure comes out quarterly. I keep an eye on this, and it's jumped around a little bit. You get little false bumps up and then it'll go back down. You get another false bump up and go back down. But the latest figures, to me, this is clearly a trend. Nationally, we peaked out, I'm sorry, if you go back one more, we peaked out at about 69%, and then it went all the way down to around 63% at the trough, and now we're closer to about 64.5%. So it's basically gone up 150 basis points with more homeowners. Now, this trend we're also seeing all across the nation. If you take the nation's largest metro areas, you can see here that they're all showing increases in home ownership rate. So these are the national figures. What about Portland Metro? Well, we're seeing the same kind of trends here. We bottomed out at about 59%, and now we're up to about 64%. But what I find interesting about these figures is that these are not necessarily people leaving apartments to buy homes. What's happened is, because of the trouble during the crash, a lot of single-family properties got into trouble, became rentals, and so consequently, our percent of single-family rental homes has dropped from 16 down to around 13%. And what's happened is we've basically lost about 10,000 rental units out of the inventory. So this has been another reason that has helped the apartment market. So in conclusion, on demographic and population trends, the indicators nationally, they all look pretty good. The indicators of the state of Oregon look good. And the indicators for Portland Metro look good. But everybody in here has read the newspaper the last 60 days and knows all the things going on. We got the government shutdown and turbulence in Washington. We've had a tough stock market with a loss of about 6% in last year, which to me is important because it impacts the wealth factor in terms of maybe buying a car, going on vacations, or how you spend your money. We've also had Apple's announcement of decline in some of their iPhone sales. And some people consider that the canary in the coal mine that kind of gives us an indicator where some things are going. We also have some modest increases in interest rates. And we've also, with a lot of forecasts, there's talk of possible recession, not necessarily in 19, but in 2020 and 2021. And we've also had a huge increase in government regulation in the city of Portland, which I'll be getting into. So I'd like now to sit down for a minute and turn it over to Patrick Barry. Patrick will cover apartment construction and income expenses and a few other issues. Patrick has been the lead appraiser in our office on about 30 proposed and brand new apartments over the last 2 years. He keeps detailed figures on the pipeline of new units coming on. I think he has as good a handle as anyone on what's happening with land values and what's happening with construction cost and absorption. So we'll now turn it over to Patrick.
Great, thank you. So I want to talk to you about construction costs, construction, supply, demand, and then some of the fundamentals with income, rent, expenses, vacancy, some of those information. So what's happening with apartment construction? Well, it's busy. In 2017, we had permits issued for about 10,000 units, and this will be the busiest year.
Just don't let him take it away.
2017 will be the busiest year on record, and for many years to come. It's actually 2,000 more units in 2017 than any previous year. So for 2018, we're down 30% on new units, but it's still going to be one of the busiest years of all time. In the past 5 years, we've added somewhere between 35 and 40,000 new units. We currently have about 10,000 units under construction, and the units are all located where you think they're located. About 75% in Multnomah County, most right in the urban core, another 10% in Washington County, 10% in Clackamas County, or 10% in Clark, and then 5% in Clackamas. We're starting to see some signs of life in the suburbs. Most of these are big institutional projects. Can't hear. Most of these are big institutional projects. Not many kind of infill type projects out in the suburbs. And we have about 32 to 35,000 units proposed, but you got to take this number with a big grain of salt. We've been keeping track of these units since about 2013, 2014, and it's really hard to determine when a project should be taken off of this list. So if it was proposed in 16, the permit's still active, they haven't broken ground yet, is this really a current project? Is this really in the pipeline, or is it not? We get a lot of, while there's still a large pipeline of projects, some lenders will pull the plug, some developers will pull the plug. I was talking with someone before the event started, and trying to find someone who's willing to lend on an apartment deal these days, it's becoming more and more difficult. And we also had a lot of activity that came in just before the implementation of inclusionary zoning. And these may not have been real projects, but just owners trying to get their land entitled before inclusionary zoning came around. So in the fall, I wrote an article for Multifamily Northwest that covered apartment construction. And I addressed construction costs. And I surveyed 5 developers and 5 contractors to get what's happened with their costs since 2014, 2015. And don't focus so much on the per square foot, but really on the average change. Some people included soft costs, some people included a developer's fee. So that can, it's not apples to apples. But these developers and contractors reported between 9 and 12% average annual increase. This is not total, this is average per year. And it's dramatic. And if you compare this with rents and values, you definitely see a disconnect there. And what it tells me is that early on in the cycle, there was huge margins. But as we've moved through this cycle, margins are tight and they're getting less favorable as the farther we get on. So what about fundamentals? I want to talk about vacancy, rents, income, expenses. There's a lot of different vacancy surveys out there, and the difference really depends on how they count the units. Do you count the unit, how you count new units? Do you count it the day it comes on the market? Do you count it after 1 year? Do you count it after 2 years? How do you count a unit that's been rented but is currently unoccupied? So that's what causes some of this variation. Reese has the national vacancy rate at about 4.8%, which is up 40 basis points from a year ago. If you get down to Portland, Multifamily Northwest has us at 4.4% vacancy. That's actually down 40 basis points from 6 months ago. But keep in mind that they don't include a new unit until it's been on the market for 2 years. So they're really missing everything that's been built in 17 and 18. And if you look at CoStar, they have us at about 5.5% vacancy, and that includes an 8% vacancy on new units and about 4.5% on seasoned units. But CoStar counts the units as soon as they come on the market, so there's some difference there. You know what? In our travels, I'm really not seeing any significant weak spots in the market except for the newer, high-end urban units. And we're also seeing some softness in some of these vintage urban units that have been updated or upgraded to a point where they're now competing with the entry-level new units. And I'll go through an example here in just a minute. This is a chart from CoStar. The left is total rent, and it corresponds to the line. The right is rent growth, and it corresponds to the bars. But I want you to look at this period from 15 to 16. At that point, we were at rent growth exceeding 10% year over year. And looking back, I think maybe some of us can agree that this was too strong, and the shift of power shifted too far to the landlords. And a lot of the political turmoil that we're seeing today, Mark's going to discuss, it was brought about by this period, even though the fundamentals of the market are vastly different than they were in 15 and 16. It was such a shift of power that the fallout is still occurring today. Rent growth in the past couple of years has been closer to 2% effective rent growth. And with a wave of units coming online, CoStar is actually forecasting that we get close to 0% rent growth in 2021. During the appraisals that we complete, we're looking really closely at the rents attained in year to date. And it's not surprising at all to see rents attained in 2018 that are actually lower than attained in 2016 or 2017. Most owners we talk to, if they can re-rent the unit for slightly lower or rent it for slightly lower or the same rate, they're content with that. The idea of getting these big rent increases these days is just not out there. Here's the graph I mentioned from CoStar that in the first half of in 2019 and the first half of 2020, they're expecting a big wave of units to come online, which coincides pretty closely with the decrease in rental growth. So we follow concessions pretty closely. Concessions have always been readily available on new units. All these new buildings are in a race to stabilize, but they're becoming increasingly common on some of the urban older units and some of the suburban units. Part of this is seasonal. Part of this is just a softening market. I spoke to a group a few months ago just before Christmas, and I know it's anecdotal, but the concessions appeared much more aggressive at that point. There was a lot of 8 weeks free rent, 6 weeks free rent, free TVs, $1,500 cash back. I just couldn't find those this time. And I'm not sure if it's a shift in the market or maybe we got past the holidays here and people are less incentivized to offer concessions. But this is one where on the top you have an older, upgraded vintage property. You know, they're asking $1,250 with 8 weeks free rent, puts you at about $1,045 effective rent. And below that you have a brand new unit, similar location, similar unit size, similar unit type. They're asking $1,195, 4 weeks free, which brings down the effective down to about $1,095, which all of a sudden you would never expect these two units to compete, but here they are competing with each other. There's another building just a few blocks from here. I cut off the incentive part, but it was 2 weeks free. Another one downtown, this one was 4 weeks free. Brings the effective rent down to about $1,170. And then you move out to the suburbs. I just pulled this yesterday. This is one of Trion's properties that they upgraded. And they're offering 1 month free out in Beaverton. In Tualatin, they give you free rent in January. And then East County, this one had 2 months free. Every time we do an appraisal these days, we're watching the collected income like a hawk. A lot of these concessions will be given in the first month and the rent roll looks great. Really high rents, but you go to look at collected income and they're down. So we're really focusing on collected income. Just in the past week, we did a couple of appraisals. And the first one, we compared the first half income of 18 to the second half. The first one was down 3%, the second one was down 5%. So we're really keeping a close eye on this. In general, we saw income up about 2 to 4% in 2018. And if owners are offering concessions, they would much rather offer it on the expense side and not take a hit on their income. So we're seeing lots of gift cards, TVs, even cash back. So apartment expenses, they've been fairly stable and predictable in recent years. Property taxes up 4 to 5% over the year. Utilities in that 2 to 4% range as well. Management, we have seen a few new players enter this market, and they're using technology to really drive down some of their fees, such as paying all rent online. They no longer accept paper checks. They have coinless laundry, so they're not out there collecting coins. And then the idea of self-showing units. Are you guys familiar with self-showing units? Anyone? There's a company out there called Rently, and you rent. There may be a registration fee, but you can rent a lockbox from them, and you place it on the unit. And the tenant goes and they register online, they put in all the information, and they actually enter a credit card as well. And they're given a code and a window to go see the unit. So then they can go show themselves the unit. And it costs the owner about $30 per month, which if you start adding in costs of your manager driving all the way across town, spending 2 hours to show a unit, and the tenant may not show up, they may not even lease the unit. So I think that we're going to see a rise in this, especially on properties where they're not big enough to justify an on-site manager, and property managers that have a big geographical footprint and don't want to spend all their time driving across town. On the repair and maintenance side, the biggest problem we're seeing is a lack of available employees. The construction trades have been so strong that they're wooing away a lot of these maintenance and repair employees with higher wages. We're hearing some owners talk about turns that are taking longer because they can't get the carpet supplier out there, or they can't get someone to paint the unit, replace the countertops, just kind of general stuff that they could usually get on a few days' notice. Now they're having a little more trouble. And one other trend, we continue to see free Wi-Fi. Something else we've seen recently is actually the property we just did. It was an older vintage property. They upgraded the units, but adding a washer dryer to each unit just wasn't feasible. So they took the laundry, or took the mop closet in the hallway and put in a free stacked washer dryer for all the tenants to use. And it was a small building, and it cost them minimal, but they feel that they can then push their rents because here they offer a washer dryer 50 feet from your unit as opposed to going down to the basement. And with that, I think Mark's going to take over, touch on some of these politics here.
Great. Great. Thank you, Patrick. Okay, I'd like to briefly talk about the political environment. And normally, I don't go there. But it's become such a big issue that I just want to cover a few things. The election for our governor, I think it was, 45 to 50 she won percent. And so a pretty clear mandate for the agenda. Also, we've had a shift in the Oregon House where she now has a supermajority. So, and this is relevant because last year the big battle was with the rent control. The key vote was Rod Monroe, who was decisively defeated. So it's a little different makeup down in Salem in terms of what's happening politically. In the city of Portland, there has been a major change, and a major change in sentiment. And in particular, we have 2 new members of the city council. And keep in mind that there are major issues that have been coming up, including inclusionary zoning, the relocation costs. One of the big ones now is security deposits, also screening criteria, and the residential rental registration. How many people got this in the mail? Okay, just a few of you. Okay, so basically the city of Portland is requiring that every rental unit in the city file, or every rental owner file a form with all their information on all their rentals, where they are. And so they're getting a database. There are some reasons for the database, maybe keeping track of all the rentals out there and having a good information source, but also people are concerned that maybe this will be the forerunner of rent control. Another issue is additional fees. The first year there are no fees, but it's open, and I would not be the least bit surprised if they go ahead and exercise the option for the second year to kind of kick in some fees. You also have a very organized Portland tenant union. And I thought Patrick's chart there that showed the rents going up so much, a very strong group that's gotten together and is very organized. And they can marshal the troops for a demonstration fairly quickly. I'm active in a group that has a meeting here once every 6 months, and there was a demonstration outside before the meeting. Also, you will have where issues will come up, and maybe it's a smaller apartment, but they can kind of get the pickets out there and use some different methods to kind of pressure the landlords. And part of this is that the rents were going up so fast and so quickly that there's been a big pullback. The latest issue is in front of the city council is on screening criteria, and it mainly has to do with criminal. And there are people out there who have made some poor choices, maybe have spent some time, some hard time, and they're coming out. And the thinking is that you want to strike a balance between giving them a second chance and getting back on their feet, and plus protecting the safety of the tenants. So you've got lots of criminal issues which may range from a minor misdemeanor to maybe some pretty serious felonies. So this is a battle that is heating up this week, and as the bills kind of get lined up. And there's also some political organizations from both sides, and I think there'll be a lot of pulling and tugging, and we'll see what shakes out with this. Also in the news has been Holgate Manor, and they had a tenant rent strike, which got a lot of press. The management company has hired a PR firm. There have been a lot of legal expenses, and in the last week or two, the ownership has been, they filed a $9 million lawsuit, and this is an 82-unit apartment. So, you're talking some big money here. The attorney is not some unknown that's working for legal aid or something. He's one of the most prominent consumer advocate lawyers in the city of Portland. And you look at his resume, he's used to some pretty big battles. So this has kind of become the poster child. Now, the owner happens to live in San Diego. Somehow the Portland Tenant Union got in touch with the Tenant Union down in San Diego. He's on the board of the art museum. And what do they do? But they show up at the San Diego Art Museum with picket lines to protest what's happening at this property. So the result is clearly increased costs, increased risks, and I think it can have an impact on value. And I'll be talking about kind of values in the city of Portland shortly. There's one other thing going on, and that is the change in the zoning for the state of Oregon. And I think a proposal from, I believe it's Tina Kopak or someone else, but one proposal is for all cities 10,000 and above to allow duplex, fourplex, and single-family zones. And this would clearly have an impact on Portland. We'll see kind of where they go with this. In conclusion, concerning the politics, I think that there are going to be a lot more battles ahead. The makeup of the city council, I don't think is going to be particularly favorable to the apartment industry. And if you look at the votes on some of these different issues, they've all, I can't think of one of them that has not been unanimous. So it's clearly going to be, I think, a tough year on the political side for parts of the rental industry. Another big issue going on is URMs, unreinforced masonry. City of Portland came out with this report. I think the science is all good and no one really doubts it, but the problem is it's become a political hot potato, mainly because of the costs. And you're talking some serious costs here. Also, apparently a lot of the spiritual leaders and the church people were excluded for some of the discussions, and they have a lot of church, particularly the urban area. And so basically it's been put on hold to restudy. But they figured they'd have a stopgap temporary measure of requiring placards to be put on the buildings. Well, that became another big issue, and there's recently been a lawsuit concerning that. Looking at the costs of URM, the city has come out with some figures, and basically it's between $20 and $100 a foot, and this is equivalent to somewhere between 5 and 30% of the value of an apartment. The data is not clear on the impact this has had, and part of the reason is that they don't know just how severe it's going to be. They're not sure when it's going to happen, and also many of the buildings that fall under this URM ordinance are trophy buildings in terms of the physical attributes and the location. And if you walk a few blocks around here, maybe 6 or 8 blocks, you can see a number of these buildings that investors are considered highly desirable from investors. As far as the placard, this is what the city council required. And basically, they kicked the can down the road, decided to study it more, but they will require that they put on this placard on all of the unreinforced masonry buildings. This has caused another lawsuit that has recently been filed by one of the most prominent attorneys in the city of Portland. So, all right, so much for the political side. What's happening with apartment values? Or what's happening with apartment sales? I think if you really look at it two ways, you've got transactions and you got dollar volume. And 2018 was a good year. If you look at the number of transactions, there were 245 sales last year versus 210 the previous year. So it was up about 17%. Even though we're a little below the peak, 2018 was the third best year we've ever had. In looking at apartment sales volume, we did about 2.1 billion last year, and it's about 10% above what we saw in 2017, but it's well below the record of 3 billion that we had back in 2016. 2018 was the third best year we've ever had. So all in all, it was a pretty good year for apartment brokers. Okay, I want to talk about values. And this is something, needless to say, this is what we do. but I try to watch this really closely. If you take a quick look at this chart, I've taken every sale of every apartment in the entire metro area and kind of put it out on a chart and done the median price per square foot. So it tells you, gee, 2018 was a good year. Values are up 8%. But what really happened was, if you break it down, say, on a quarterly basis, you can see things peaked out. They were pretty weak in the first 3 quarters of 17, very, very strong in the fourth quarter. And since then, they've actually pulled back. So what it tells me is that values are flattening out. And in some markets, it's pulling back a little bit. So this trend we're watching closely, and I find particularly interesting. So what about different market segments? Well, I've tried to kind of look at a couple different market segments to see what's happening. If you take new units, and lots of the new units are built for sale. So if you take all the new units, you can see here the price, it kind of peaked out in the first half of 18 and has pulled back a little bit. If you take apartments in the city of Portland, this trend I find interesting. If you take every sale of every apartment in the city of Portland, you can see it's pulled back a little bit in the second half of 18. So the reasons may be interest rates, it may be the political environment, it may be rents flattening out, it may be expenses, it may be interest rates going up, or I'm not going to discount the possibility that the sample size could somehow impact that. But the big issue I'm seeing is things are flattening out and maybe pulling back just a little bit. I also looked at suburban apartments built from 1960 to 1980. And this was the golden era of apartment construction in Portland Metro. And they couldn't get them up fast enough. And these were the most apartments have ever been built in this 20-year window. And so you can see here that some of the same trends where it was kind of peaked out in the second half of 17 has pulled back a little bit in 2018. Now, Patrick put together a chart which I find really quite fascinating. If you take the median price per unit of different market segments, 3 to 8 units and 9 to 50 units, and then 51 units and over, you can see that the 3 to 8 unit properties have showed some gradual increases. You can see where the 9 to 50 units have shown some gradual increases, but the bigger properties have pulled back a little bit in 2018. So the reason might be maybe you have a little more sophisticated investor, maybe somebody that watches that ratio a little closer on the spread between interest rates and cap rates. But to me, this is pretty good evidence that things at the high end have pulled back just a little bit. Now, I want to run through briefly just a few sales, just kind of shows you some of the typical trends. This building just sold in November, about 134 a unit. It's on the low side, but there are a lot of studios in there. The next building is out on the light rail, kind of a tough location. This kind of represents maybe the lower end of the range on the per unit, somewhere around 117. Typical suburban property selling for about 138 a unit. The next property I find kind of interesting, and all of a sudden we jump out to Newburgh and you see the prices kind of lower, maybe 87 a unit. But what's happening is investors can't find the yield and cap rates on properties in the more developed areas, so they're pushing out to some of the fringe areas or to other markets just because you get a better yield. Now, this is kind of an interesting situation. The guy bought the property. He did some upgrades and tried to kind of reposition it. He got a lot of pullback from the tenants union. There were pickets, and they actually had pickets at his house in Raleigh Hills. So this guy, he wasn't a real, I mean, maybe, I don't know what his experience was, but he had it. He had just had it. And so he put the property on the market, and based on all the sales I see, he probably sold it maybe, I don't know, a 3 or 4 or 5 or 6% discount just because of some of the troubles he had had. So I thought that situation was kind of interesting. The final picture on one of the apartment sales is a value add type property. And the city of Portland value add is a lot tougher because you have the relocation costs you have to make if you evict a tenant for no cause or if rents go up more than 10%. So this guy has bought tons of properties, probably, I don't know, 10 or 15 in the city of Portland, kind of done the repositioning. But now he's going to the suburbs, and you have to think the reason is because maybe it's a little friendlier political environment. So, who's buying apartments? Well, all the brokers know this, and they're well aware. You know, you've got an investor out in East County that has bought an amazing number of apartments. And Stark Firs, you see their great big sign everywhere. You've got Nick Klein, Tryon Properties, and then some others. But what's interesting, at the bottom of the list is Blackstone. And who is the largest financial institution in the world? Blackstone. So Blackstone is in our market buying apartments. So who's selling apartments? Now, you've got Holland Group. Holland's a big developer and really a merchant builder in that they buy to sell. But I remember the last, during the crisis, during the Great Recession, that Clyde Holland would give talks at some groups, and he talked with great pride that he completely sold all his inventory before the crash. But he is the biggest seller of apartments, and 4 times as big as the next seller. You know, NFN is kind of repositioning their portfolio. Then you've got others. Some of these are estate-related reasons and trades, and not necessarily indicative of some softness in the market. Okay, apartment land. I don't want to go into apartment land, but I do just want to put this chart up there because you can see how many sales there have been. And with all the apartment construction, it's been a very active market. As appraisers, we have to kind of keep our eyes open that if you get, say, a house that sells, maybe it's really for the land, or maybe it's an underutilized commercial site that they're going to build apartments, but there's a lot of activity. And we're working on appraisal right now. The land values, kind of the upper end is maybe $40,000 a unit, and in the urban area, it seems like values are closer to the maybe 90 to possibly $100, $150 per unit. So now the next slide is something, this is probably 90 or 120 days dated. But I think we got a trend line here. And so we got to ask ourselves, are we in a bubble? And is it different this time? Every time the trend line has the values have gone above the trend line, it's pulled back. Every time it's gone below, it's pulled back, going back to 1989. But we're way above the trend line right now. And so I think this is an issue of concern. It's not only the price per unit, but also the price per square foot. Now, on Friday, at the end of the day, I kind of pulled these figures on the stock market. And so what you've had is low interest rates, so it's encouraged people to leverage themselves to take risks and maybe have that spread between their cost of money and what they can get or anticipate. So the stock market, if you look at these figures on the price to earnings multiple, even after the big pullback recently, we're at the highest PE except during the dot-com era and the recession, or the Great Recession at Black Friday in 1929. So to answer the question, are we in a bubble? I think it's probably no. If the economy holds, and if interest rates stay low. But if the economy kind of goes south on us and interest rates move up, I think there clearly be some pressure on values. I couldn't help but bringing an article from Martin Feldstein, and he was the head of the Council of Economic Environments, and he's kind of playing along the same theme as this guy, Peter Schiff, who apparently is a pretty well-known financial guy. But Martin Feldstein says, another recession is looming, stocks are at an inflated level, ultra-low interest rates encourage investors to borrow, and sending asset prices skyrocketing. But the asset prices skyrocketing, that's clearly what's happened in the apartment market. And anyone who's seen this market the last 10 years since the depths of the Great Recession knows how strong that market's been. He goes on to say, rising rates will push down the stock market. If stocks get down to the historical norm, it would result in a loss of $10 trillion, or 40% of the value. So who knows whether that's going to happen or not. It's certainly a doomsayer thought, but if you look at the trend line, you get back to the trend line, where he's probably not too far off. He also goes on to say that Congress won't be able to spend money to stimulate the economy if it does go south, because there is so much, the debt levels are currently so high. He says the next recession will likely be deep and long. There's nothing the government can do to prevent it. Food for thought. Okay, where are we going? So I've tried to poll some well-respected people and organizations on their thoughts where the market's going. This happens to be from the state of Oregon. I think the world of the people down there, they're top-notch and they're top of their game. But generally, their forecasts are for a little bit of, generally a softening in 2019, a little bit slower, but that once we get into 2020 and 2021, that's where things will go further south. And in terms of employment and GDP, if you look at these figures, also by the state of Oregon, they call for continued job growth, but at a slower rate for the state of Oregon. And once we get into, say, 2021, they're forecasting that the population will not be sufficient, or employment gains will not be sufficient to meet the needs of the population growth. So we'll see. Also, probably the most severe forecast was from Moody's and CoStar. And if you look at these figures of the job growth, basically they're forecasting negative job growth, very slow job growth in, or declining job growth in 19, very slow in 20, and end of 20 and 21 actually have a negative job growth. Okay, what about interest rates? Well, I don't know where interest rates are going, but I just, this is a well-respected organization, basically Freddie Mac, and they spend a lot of time and money in what they're the biggest lender in the nation in terms of housing. So their forecasts are in the next year or so that interest rates will move up about 100 basis points. And this happens to be housing interest rates, but I think you can translate that into other assets like commercial real estate. And if you're a believer in having a spread between some base on interest rates, it probably does not loom well for commercial real estate. So, where are we in the cycle? Now, this guy Mueller, he's a PhD out of St. Louis. I kind of follow him. On, what I like about it is that he goes through every single property type, retail, industrial, office, and multifamily, and he comes up with some figures where he sees us in the cycle. And it's as of the second quarter of 2018, so it's a little bit dated. And my guess is that if we had current figures, it would probably be just a little further down the line on the right. But basically, he goes through all the different metro areas and has Portland in the hyper supply stage. So hyper supply, there are 5 criteria. And let's see if Portland qualifies. Increasing vacancy rates. Yes. Moderate to high new construction, yes. Low to negative absorption. Well, I wouldn't say low to negative because our absorption has not been too bad. Moderate to low employment growth. Our employment growth has been good, but it's pulling back a little bit. And finally, medium to low rental growth, which is certainly the case. So I love this time of year because you get all these forecasts. And then I can use it and come here and talk about kind of the so-called experts. But this just came out last day of the new year. CoStar has become a major player on some of the data and analysis. I thought, and they're not bashful about kind of expressing themselves. And so they kind of really stuck their neck out and saying apartment prices will have the first annual drop since the Great Recession. And so as an appraiser, it's a little hard to argue with their figures because as an appraiser, you got income less expenses equals NOI and capitalized into value. So you've got some forecasted slowdown in employment, you've got flat income, you've got a little higher vacancies, you've got some pressure on expenses, and you have increasing interest rates. So where is our apartment market going in 2019 and 2020? I think the biggest risks facing the market are two: interest rates and employment. And the reason is that there's a freight train moving forward. And when you leave here today, you'll see all the cranes and all the stuff under construction. But if our employment pulls back, that is not stopping. And so that's going to come on. And I mentioned the cycles. I've been through a few of these cycles, and I'll never forget one of the cycles when things died, but you had incredible construction coming on. And there were a lot of problems that resulted. So to me, last year we were at 25,000 or 27, somewhere in there. We've been up as 35, but if we get down to 10,000 or 12,000 jobs per year in Portland Metro, that's going to be a tough market. And those numbers are not terribly bad, but they're a big difference from what we've had to support our economy and apartment market here. Interest rates, again, I go back to that spread over one of the bases, and the forecasts are for interest rates, at least from Freddie Mac. Who knows? I don't know, but they're kind of the experts. Also, those job figures kind of don't loom well that we had in December, and the Fed has kind of tipped their hands, even though Trump's kind of pressuring Powell. There's some, there's likely we'll probably see a couple bumps in 2019. So I'd like to conclude with some trends I see for 2019 through 2020. And these are not necessarily my figures, but I've kind of taken from experts. Interest rates, I think the consensus is, maybe 2-3 increases in the Fed funds rate. Employment, everybody is kind of forecasting a little bit of a slowdown, and we've seen that the last few years, from our peak of 37,000 jobs down to, or 35,000 down to somewhere around 25,000. As far as population growth in Portland Metro, the latest forecast I've seen is somewhere around 27,000, and that's compared with as high as 40. So 27,000, you do your quick back of the envelope, and it tells you maybe the demand for apartments will pull back a little bit. Homeownership ratio, who knows where that's going, but it seems to be kind of creeping up. Apartment construction has been very strong. There's a big freight train moving forward. We're not going to stop it, but the permits are clearly slowing down. Apartment vacancies, the figures vary, but they tend to be moving up a little bit. Apartment values, there's clearly some pressure on apartment values, and I've shown that by the figures for Portland Metro in 2018 and just some of the national forecasts. And finally, there's a little less enthusiasm and optimism for the coming years. In conclusion, the apartment market is good. The economy is good right now. I think there's enough momentum. We're going to have pretty good fundamentals in 2019, but it's going to be flattening out. And it's probably good because maybe things got a little bit ahead of us. This winter was challenging for renting units all across the board, and part of it is just seasonal, but I think part of it may have to do something with the market. I think 2019 is expected to be a decent market, but with some challenges. But all the forecasts I see are for a little tougher market in 2020 and 2021. So that is kind of how I see things going on in the apartment market. And Dave, if there's time, we're available. Any questions?
Good question. Ron?
What do you think, maybe this is Patrick, but what do you think is mainly driving the increase in construction costs? Is that trend mitigating at all?
I think it's just a demand. I think there was a report last year that came out from the Oregonian that said the current construction market could absorb 10,000 workers tomorrow. And I think there's just a high demand. I think people are quoting things 6 months out, and if it comes in, great. I really think it's just supply and demand, though. For construction costs, yes.
Patrick, what were the comments in city of Portland? I saw the metro area one, but I don't know if I missed the Portland one. 28.
I think it was approaching a little over 5,000, just for Multnomah County.
So that's still over average most years.
Yes, that would be, the permits just in Multnomah County are probably close to our long-term average. Yeah.
Is this is your report or some version of your report going to be available online?
Yeah, it'll be available on our website later today. Yeah.
Yeah. Question with the potential slowing down of, do you see construction slowing down in 2019, and maybe with that, do you see construction costs starting to decline?
It's tough construction costs. I'm just not really involved in that segment. I do see things slowing down. I see a lot of these pre-inclusionary zoning projects running out, and I think we'll have a slowdown of projects. I know a lot of developers just don't want to tackle inclusionary zoning, especially the mom and pop owners. A lot of these national developers, they've dealt with inclusionary zoning in other markets. They can figure out a way to deal with it, but especially the mom and pop kind of developing for themselves, especially, they're just not going to deal with it.
I see that you show home ownership ratios moving up, you think, next year. Is that tied to the fact that you're projecting that apartment vacancies are trending up? Or?
Oh, it's definitely, it makes a big difference. You know, a 1% change in home ownership means there's 8,000 fewer potential renters. Mm-hmm. So while they're not all renters, some of them may be living at home, some of them may be in roommate situations, it definitely takes away from that pool of potential renters.
So home ownership ratio is still moving up even if cost of construction is really high?
And
interest rates go up?
I would assume so, yes. I think a lot of these, especially millennials, they've been renting for so long now. They've saved down payments. You saw the Portland job, the median income, they're ready to move. They're ready to move into a home, so.
Patrick?
Are we building enough single-family homes, though?
You know, we don't follow the single family. While you live in both, we just don't follow the single family home development as much. Yeah.
Patrick, I have a question for the man of many cycles, your father, Mark.
Yeah.
You talked a little bit about the political climate, and I think there's one bright spot in that, potentially, and that is, and I wanted you to speak to this, and that is the legislature passed or gave the municipalities the ability to pass bonds and get into the housing business. Do you see that as having any potential traction, or would just get mired in politics?
You know, it's a lot of more money out there for people that didn't have access to it. And I think with the size of that bond, if they have access to put more units, that we could get a lot more units coming on. And the city of Portland has a big pot of money that they're have got stuff in the pipeline on. So I think that could kind of help as the rest of the market kind of pulls back. You got the public money that can sort of continue building. So.
Hey, Patrick, on the when you do your forecast over here,
When you do your forecasts on construction for
Yeah.
apartments, do you ever go back and revisit those appraisals a year out or 2 years out to see what your forecasted rent was versus actual rent? Or not to make you not have anything else to do, but go back and redo whole work.
When one sells, I'll go back and take a look on where we predicted for the final value. But a lot of these rents, I won't have access to. Maybe I'll encounter it in a rent survey down the road, but I typically don't go back and try and figure out where the pro forma rents compared to actuals come in.
Is there questions?
Yeah,
You want to wrap it up, Mark?
I'll wrap it up.
So-
I just have one question for Mark. Mark Berry. I didn't know if there are any other Marks here. So you were talking about institutional properties, and then you're talking about investment properties for people that might be investing long-term. They're not building to sell. They're building maybe to hold. And if they have the right financing, especially at historic low interest rates, they might be holders of their inventory for a generation. Do you see that the market might be impacted more for the build to sell than for the investor?
Absolutely, that's a really good point. And there are so many people that are long-term owners, and they don't care if things go down, 2 or 3 or 5 or 10%. They're in there for the long haul, and they're not sellers. They're buy and hold, and many of them will have had the property for years and eventually get it paid off. And so they know Portland's a decent place, and I don't think that this market, they're going to stay in there, and it's not going to have any impact on them. I think the impact, any kind of pullback, will be kind of your value add people and maybe your construction people selling who are merchant builders and building to sell, because you can get caught where your costs are going up and all of a sudden the market dies on you and you can't unload the property at a decent cost. And God only knows, I've seen this in some of the cycles where you get a tough market and you got this freight train moving forward, but we haven't seen it since the Great Recession, but that's, to me, one of the big risks out there.
Thank you, Mark. Hey, one quick comment. Vic, you sort of reminded me earlier. So Vic Baker, about a decade ago or more, maybe 2 decades ago, we're sitting here during a marketing session talking about the sports fans in the room. Jim Rome, you remember him, have a take, don't suck. So I just want to say, Mark, Patrick, it's great to have you guys come in here for an hour and get us up to speed. You had a great take. You didn't suck. And it's up to us to deal with what you've told us. So anyway, thank you very much.